Hi students, so this lecture for BBA 4th SEM on corporate accounting second. In last lecture we discussed on the incorporating entries in the books of the transferee under the purchase method. In the last class we discussed it means what's actually there are three steps are there for preparation of the amalgamation problem. First step is what's to prepare the purchase consideration. Second one is what's closing entries in the books of the transferor company, and the opening entries. And the opening entries, if it is problem is related to the merger, then the separate opening entries we have to pass into the transferee company. And if the problem is related to the purchase considerations, for that purpose also different entries we have to pass. Okay, so like these steps are there. Okay, so in the last class we discussed the opening entries in the books of the transfer company under the merger method as well as purchase method. Okay, so now we will, and I hope all of you understand that the whatever we discussed. And now in this class we will see the distinction between the pulling interest method and the purchase method. Okay, so the pulling interest method means what's the merger method. Okay, so merger method. So now see this is the table is there for the difference between the pulling interest method and the purchase method. So first point number one, which is the applied. Okay, so applied, it means what's the whatever the purchase method or the in pulling interest method. Okay, so this method is applied in case of amalgamation in the nature of merger. Okay, in the nature of the merger. And if this applied, when it's applied, when the this method is applied in the case of the amalgamation in the nature of the purchase. Okay, so this is the applied points of the difference. Next, second point number two, which is the reserve and surplus. Okay, so reserve and surplus point number two. Now see, so whatever the reserve and surplus are there, so this reserve and surplus in the pulling interest method, the reserve and surplus of transferor company are transferred to the books of transferee company. Okay, it's a transfer to the books of transferee company. But in the purchase method, whatever this reserve and surplus are no, so this vendor company means what, which is the transferor company. So this transferor company are not transferred to the books of transferee company. Okay, so this is about the reserve and surplus difference between for the pulling interest method and the purchase method. Now third point number three, the adjustment. Okay, the adjustment is what's, so in the pulling interest method, whatever the purchase consideration is there as well as purchase consideration is there, it means what's whatever the difference, whatever the difference between the purchase consideration and the share capital. Okay, purchase consideration and the share capital of transfer company is adjusted into the reserve and surplus. Okay, so whatever the difference is there, so under the purchase consideration and the share capital, so this difference, it is adjusted in the reserve and surplus under the pulling interest method. Okay, so but in the purchase method, this adjustment, purchase consideration and the net assets of the transferee company is treated as goodwill capital reserve. Okay, so purchase consideration and net assets of the transferee company is treated as goodwill capital. Now this adjustment is related to the purchase method. Purchase consideration and net assets of the transfer company is treated as what's the goodwill capital reserve. Okay, so now point number fourth, which is the valuation of assets and liabilities. Okay, valuation of assets and liabilities. So this, whatever the valuation of assets and liabilities for the pulling interest methods, so all the assets including fictitious assets and liabilities of transfer company are transferred to the at book values. Okay, it is transferred at the book value. But the valuation of assets and liabilities, so it is what only the assets and liabilities taken over by the transferee company are transferred at agreed values. Okay, so which values, the agreed values. Okay, so whatever the assets and the liabilities are taken over by the transferee company, no, from the transferred company, it is transferred at the agreed values. This is point number four. Okay, so next point number five, which is the statutory reserve. So for the statutory reserve, so this point is related to the what, the points related to the pooling interest method. These statutory reserves such as the foreign project reserve, development repeat reserve, etc., are transferred to the transferring company, but no spare account is opened. Okay, so no spare account is open. So no spare account, which means the separate account, it is not the separate account. Okay, so but in the purchase method, a separate account called amalgamation adjustment account is opened in the books of transferring company to record statutory reserve transfer. Okay, so for this for recording of the statutory reserve, for that purpose they are preparing the new amalgamation adjustment account. Okay, so this is about the statutory reserve. Next, point number 6, which is the amalgamation expenses. Okay, so this amalgamation expenses for the difference for the pooling interest method. So amalgamation expenses paid by transferee companies adjusted to reserve and surplus. Okay, so it is reserved to the, so reserve and the surplus. Okay, so but in the purchase method, no. So this amalgamation expenses, it is paid by the transferee company, is adjusted to goodwill. Okay, so it's adjusted to goodwill or the capital reserve. Okay, so these are the expenses, these are the difference between the amalgamation and the, it means amalgamation of the pooling interest method and the amalgamation of the purchase method. Okay, so it will come for the 5 marks, and it's very easy to understand this difference between the, difference between the what's the purchase pooling interest method and the purchase method. Okay, so I hope you will be the understand. Thank you.